Yeah. So, very good afternoon, ladies and gentlemen. It's my pleasure to extend a warm welcome to all our esteemed partners and colleagues joining us today for this special web call focused on GM Small Cap Fund NFO. So, we are privileged to have with us Mr. Asit Bhandarkar, who is a senior fund manager with over 2 decades of rich experience in equity research and fund management. Mr. Bhandarkar holds a master's in management studies in finance from Mumbai University and has made significant contribution to re-own the institutions such as Invesco EMC, SBI Fund, Jet Edge Securities, and Sushil Finance. With his deep insights and expertise, Mr. Bhandarkar is sure to provide invaluable perspective on navigating the intricacies of the market and understanding the nuances of this small cap NFO fund. So basically, let's extend a warm welcome to Mr. Bhandarkar and make the most of this opportunity to gain insights and knowledge that will guide us in the investment journey. Thank you so much for making this possible, sir, and over to you. Thank you, Mr. Bhandarkar.
Hey, Disha, thank you very much, and I welcome all our partners, on this call. Thanks for sparing your time this afternoon. Your participation encourages us to do, all the time. And, it's been one of the pillar of support for us doing so well. Thank you very much. I'll now move to the topic of the day, the small cap fund that we have launched today. And, I think the biggest question that needs to be answered, why small caps? Should we as a should we even look at that segment? Because, I think, there are a lot of fears in the mind that what will happen, small caps are risky, what about the valuation? I'll cover all that, but most important, should we even look at small caps, and what is the risk reward, or what is the reward in the long term that we should look at? See, this slide in front of you looks very simple, but there are some images on it, and I think I'll sort of summarize, the opportunities available. During my address, we may talk of certain companies, as examples. Please do not take them as an investment advice. We might be selling some of the companies or, buying some of the companies, but the point is these are not investment advice. This would be just to drive home a point, in terms of the opportunity. Now, if you see on the, on your screen, you can see a burger there, right? And if you see one of the largest companies, which runs the McDonald's QSR in the country, runs about 450 stores. That's a small cap. I'm referring to Westlife, which is the franchisee of McDonald's in this country. The opportunity in such QSRs is so huge that we can see that, China, which is probably about 20 years ahead of us in per capita GDP growth, today has 10,000 McDonald's stores. So it's a multi-year opportunity, and it's available only in the small cap. You'll see a beaker there, and that sort of signifies Path Labs in this country. And one of the largest Path Lab companies, is Dr. Lal Path Labs. That's a small cap, and we are in a post-COVID. We have seen how healthcare has sort of taken a center stage, and preventive healthcare particularly is growing so well. So now this again is a small cap, great opportunity, again is a small cap. You would see some signs of cinema reel, and that represents the movies and exhibition business that is there. And two of the companies in that space, Inox and PVR, have merged, and post-merger also this opportunity remains a small cap. Entertainment in a country like India will become big business going forward. Whether one of these companies captures it or not is a different matter, but the fact is that, the largest company in this space is a small cap. You would see a pickup crane, and a lot of these cranes you will see wherever you see along the highways where construction is there going on. You would see a crane which is yellow and black in color. The largest company for pickup, 1-ton pickup cranes is Action Construction. It's a small cap. You can also see a solar panel there, and we know that how renewables are now shaping the future of energy distribution globally. And the largest solar EPC company, which is SW Solar, is a small cap. The We will also see something like a petrol pump, but it's not a petrol pump. It's probably petrol pump of the future. EV charger making company, one of the largest with 60 to 70% market share, is also a small cap. I mean, the point I was trying to make with this slide is that there are multi-year opportunities available in this country. And there's no denying that, over the next couple of years and maybe perhaps even a decade, that these will be high growth opportunities, and they're in the small cap. And if you avoid this space, then you end up not participating in such opportunities. So participation in small caps is an important part of your asset allocation strategy. Second fear that exists right now is that small caps had an excellent year last year, almost 50 to 60% returns on the index itself. And so there's a little bit of a fear. So, we thought that, 1 year data is a little bit of a noisy data, whether, you should make an investment decision on that basis or not. So we just stepped back and we tried to see how, things look on a longer term basis. We were quite surprised that 20-year CAGR of small caps is about, rather 10-year CAGR of small cap index is about 20% CAGR. It's a little bit of a premium over the Nifty. Nifty, I think, is about 15%, and mid cap is somewhere in between. So it's not as if small caps have been, hugely out of price in terms of the returns that they have given over 10 years. And I'll show you something very interesting. Between the first 5 years in this 10-year period, the returns were only 12% CAGR. So small caps actually lagged the large caps during this period. Why? And this is our assumption here, that it could be because of some disruptive regulatory events like, say, GST implementation, demonetization, even a capital gains tax that was imposed. These were all sort of these led to some difficulties, especially for smaller companies from a demand perspective, or from a demand supply perspective for the stock itself. But what we feel that one of the first and one of the best corporate, one of the first steps that government took, which was sort of pro-business in this country, was when they cut the corporate tax rate cut, in September 19. You'd remember that tax rates in our country for corporates were as high as 35%. And they were cut to 25%. And if somebody put a new plant, it could be as low as 15%. This was an incredible reform, because what has subsequently happened is it has completely changed the profitability profile for all our companies. It has completely changed the balance sheet situation, and I'll go into that a little bit in detail. And it has made our companies more resilient. So we had a difficult event like COVID post this, but in spite of that, we have seen a 32% CAGR in small cap returns from that point. And I think the bigger question that needs to be answered for all of us is that, whether, there is froth, to what extent, if there is. I think so. We try to examine whether what kind of profitability has the small caps given, mid caps given, and large caps given. When we look at the Nifty 500 PAT, we were fairly surprised that in 2018, when the last sort of a bull market in small caps ended, the profitability of the Nifty 100 was about 4.5 lakh crores. The profitability of mid-cap index, mid-cap 150, all 150 companies put together, was about 7,183 crores. And the small caps as the whole category, 250 companies, lost almost 6,920 crores. Now, this is quite staggering, because what is actually happening is in the contribution to PAT of Nifty 500, small caps contribution was negative 2%, mid cap was plus 2%, which means all the PAT of Nifty 500 came from the top 100 companies of this country. So this is how skewed the situation was about 5 years back, March 18. And when you look at March 23, the picture has completely changed. The contribution of small and mid caps in profitability has gone up manifold. If you see, as on March 23, Nifty mid-cap 150 market cap, it's almost doubled. It's gone from 21 odd lakh crores to 42 odd lakh crores. But if you see the PAT has gone from 7,000 odd crores to 1 lakh 83,000 crores. So basically, market caps have gone up 94% as on March 23, and the PAT has gone up almost 25 times. Small cap index, substantial improvement from a loss of 6,920 crores. It's gone to 1 lakh 6,000 crores of PAT. So there's very solid profitability. And now when we look at the Nifty mid cap, rather Nifty 500 PAT, the contribution, which was almost 100% from large caps, has actually come down to 74%. And mid and small put together today are contributing a respectable 25%, 26% of the PAT. So this is the big change. The point I'm trying to make here is that there has been a sharp move in market cap, mid and small, but there has been a sharper move in the profitability of these companies, and the recovery of the business has been very sharp. Also, I think one thing we have to now sort of wait and see is that country is changing right now. There are a lot of new innovations happening. There are a lot of new age businesses coming. Over the last decade, we have seen private equity and private venture funds have funded a lot of new businesses, and these are now coming into the capital market. And when we see that, a lot of these sectors are actually covered significantly in the small cap sector. So, for example, if you want a digital stockbroking firm, which is a new age business, which grows almost 3x of the normal conventional business, it's available in the small cap segment. So the count of small cap, the number of new sectors, new age businesses in small caps is actually 4 times of the large caps. So to that extent, some of the businesses of the future you are going to find probably in small caps. For example, the sector defense, about a year back was completely in the small cap segment. It was not existing if you see 5 years back. So a lot of such sectors, if you see renewable sector, thermal coal is there, of course, but the solar and wind, which would be sort of new age, and all the distribution related infrastructure along with it, that's also in small cap. So when we see these opportunities, very excited. From an IPO perspective also, where the new supply is coming. See, please understand, the IPOs today are very different, because when there is a private equity company sitting in a particular particular business for a decade, it would be running with very high standards of accounting. They would have international auditors, because these private equity funds are all MNCs, they are FIs from different places, or sovereign funds backed investors, and hence the quality of the board, versus say 20 years back, the kind of companies used to come is very, very different. And to that extent, this sort of becomes a very important source of supply for us as institutional investors or for retail investors. If you see in last 1.5 years, look at the supply gap. Large cap, there's only one IPO that's got listed from 23 till now. Mid caps, 3 companies and 3 different sectors. Whereas small caps, there have been almost 91 issues across 14 different sectors. So from a diversification perspective also, newer businesses that are getting listed, small cap sector become very, very relevant. And I think this sort of is the crux in terms of, why you should look at small caps. See, all of you will know that, we are a growth oriented fund house. Our philosophy is growth, to pick up high growth companies with, reasonable balance sheets. And when we did this study, what we did is we sorted all the companies on the basis of growth, and we put them into buckets of 100 on the basis of which is the highest growth of sales growth and PAT. If you took the top 100 fastest growing countries in this country, we were very, very surprised at the dispersion here. 60 small cap companies out of 100, top growing companies, 60 companies are small caps, and they have grown at about 30.7% CAGR. Mid caps are 25 out of the top 100, and they've grown at about 27.6% CAGR. and large caps are only 15. So basically, if we decide that we have to invest in the fastest 100 companies of this country in the Nifty 500, we would end up with 85 companies which are mid or small caps, and large caps would only be 15. And when we look at the PAT, it's even more stark. Small caps, top 100 companies would have put together, would have grown at about 57% CAGR over last 3 years. Mid cap, 34 companies, grown at about 47% CAGR over last 3 years. Large caps, 42%. Not only is there a reduction in the PAT CAGR versus the small caps, but absolute number of companies is also less, just 11. So my point is that it's very difficult to create a high growth portfolio without the participation of small caps and mid caps. That's one point here. But I think there's also another point that you can probably see on the screen here. Please move your attention to the last bucket, which is 200 to 300 companies. And in that bucket, you will see dispersion doesn't change as much. It goes from, say, 15 companies, large caps, to 21 companies. But something important happens. The large caps here are growing faster than the small caps and the mid caps. And even if you look at the profitability, the small caps are giving negative profits, versus large caps giving at least a positive growth. So the defensive nature of the large caps and large caps particularly comes through in this particular slide. And to that extent, what we have to really accept here is that small caps particularly are a stock picking game. They are not really an index game, and to that extent, I think very good stock picking skills are very important when you look at this product. What is the potential wealth creation? I think this was a very interesting slide, and this, I think, if you see, we have sorted the top 10 small cap 250 performers, mid cap, and the large cap performers to the right. And what's interesting is the 10th company of the small cap index, on a 10-year basis, has grown 45 times. But that is still higher than the first company in the large caps, which is Bajaj Finance, which has grown at 39 times. And if you see the kind of return that the small caps have generated, something like PCBL 46 times, APAR 47 times, right up to, say, an Olectra Green Tech, which has gone up some 256 times. So the returns that some of these companies have made are phenomenal. If you see the last stock in the large caps, is Adani Power, and it's gone up only 10 times. Now, 10 times is substantial return, but when you look at the small cap index top 10 performers, it looks like only 10%. Even if you look at the mid cap companies, KEI, Uno Minda, APL Apollo, KPR, Deepak Nitrite, etc., you would realize that most of these returns would have probably come when they have been, small caps, and now they do represent the mid cap index. But that. So again, the point from this slide is, you have to hunt for stocks, pick stocks, and if you are successful with that, then the return potential of some of the stocks can be quite interesting. Now, if you see the slide in front of you, this is also a very interesting slide because, I think what we have to realize is that not every company is destined to become a large cap. Right? We have a Tata Elxsi on this slide here. If you see, it's given 340% as a small cap, and then it transitioned to become mid cap, and it's given 81% from there. But the fact is that it's a software company from the Tata Group, and we'll all agree here that it's never going to be becoming bigger than TCS, which is much bigger giant, whereas this has a very specialized software need, as in the auto sector. So point being that every company cannot become a large cap. You cannot have a car battery supplying company becoming bigger than the car company itself, because the value of battery in a 10 lakh rupees car may be 10,000 rupees. So these individual companies, they have their great skills. They have they may have great return ratios as investors, and they may have great growth stories, but they will not become large caps because of the opportunity size itself. If you see a company like Timken, which is now one of the biggest supplier to all new railway trains, it's given about 250% returns as a small cap, and once it became a mid cap, it's sort of given negative returns. uh, even other companies, if you see like Grandville, Norton, Jindal Stainless, great companies with great balance sheets, but will they ever transition to become large caps? That's sort of the question that we end up with. So to that extent, good companies you can find in small caps, and you can make decent returns. And I think this, to my mind, the slide in front of you now, uh, answers a lot of questions, because see, we examined that profits have gone up for small caps, but at the end of the day, where we stand today, all the companies probably will have to put up new plants because demand is very strong. And when you want to do capex, profits don't matter, because your balance sheet strength will matter. And we tried to examine, and we were pretty surprised that in 2018, the debt equity of small cap 250 ex financials was about 0.64. And in spite of debilitating, events like the COVID, probably the Ukraine war, all such globally disrupting events, the debt equity of all the companies in the small cap index come down to 0.28. So, so today, if you want to say do capex, put up a plant, the balance sheet is very light. It can probably you be used to, put up new facilities. In absolute amount of debt, it's even more interesting that the absolute amount of debt in the small cap index was about 1,98,000 crores. That went up a little during COVID, and then subsequently, as the demand for products vanished, companies used the free cash flows to pay down their debt. And as we stand today, the absolute amount of debt is down to 1,57,000 crores, 1,56,000 crores. And what's interesting here is that this has all happened when the interest rates are at a cyclically high, 5-year high there. The opportunity in the small cap index now is that whenever interest rates correct globally and in India, any interest rate correction will directly add to the profitability of small caps and perhaps the ROE of the company also. And even there, if you see the ROE chart on the slide in front of you, that used to be 5% in 2018 with anemic profitability, and that has now gone to about 14%. That's a dramatic change. And I think what's interesting is, see, this is the point I was making about the corporate tax rate cut earlier. The corporate tax rate cut, which ensured that the 5% ROE, in 18 went to about 16% at the end of 19, and even during COVID, which was a very stressful time, ROE did not come down back to 5%. So this, we believe has completely changed the balance sheets of all the companies. And I think one more point, today at 14% ROE, a lot of investors are very happy to fund these companies or participate in the QIP of these companies, fundraisers of these companies, OFS of the companies, because this is very good return from an equity investor perspective. And today we are seeing that companies are being more responsible. They are not going overboard on debt when it comes to capex. They are using it very responsibly, and some of them are actually doing an equity fundraise right now, use the cash flows over next 2 years. So to that extent, if there are capex plan of 3-4 years, debt is taken towards the end. That would also be very, very positive, because the overall project burden, or the debt burden on the project will come off, the interest cost burden on the project will come off, and the chances that the new capex will give higher returns to equity shareholders, improve. I think this, this slide in front of you, basically, I'll not spend much time here, but it basically tells you that longer you stay in small caps, the chances of negative returns almost vanish. So please consider this product as a longer term product. Their opportunities are great, but this asset class can be volatile over the shorter periods. It is for a longer term investor, and it should be seen like that. In fact, what's interesting is the beta of the small cap index also versus large caps reduces substantially as you hold the product for more than say 7 years. Also, one point that we have to examine, and one of the biggest fears that is there in the market, is that small caps tend to be less liquid. and whether if there will be sharp volatility, how what can be the what can be the volatility, what can be the impact of buying, selling. I think this has to be seen. So we have put this slide in front of you. What used to be the as per SEBI definition, the 251st company in the Nifty 500 is the small cap, right? That number, which used to be, which where the 251st company used to have 7,000 crores market cap in June 20, as things stand today, the market cap has gone to 28,000 crores. And I believe that the 500th company, which is probably the last stock in as a small cap, in the Nifty 500, that market cap is also higher than what was the top company's definition as in June 20. So the companies and the market cap, although we associate word small with small caps, but the fact is that 22,000 crores to say, and the lower side maybe 9,000 crores is significant market cap. These are not small companies in market cap alone. And also in terms of liquidity, I think what we saw was that absolute turnover, which used to be 2,600 crores in FY20 of the small cap 250 TRI, has gone to about 14,500 crores. Now, this is very important because see, somebody who's running a say 1,000 crore fund, and you want to buy and sell, probably some, you get a 50 crore redemption in a day. On a base of 14,500 crores of turnover in the index, shouldn't be much of a challenge. So we retain the flexibility to buy, sell, meet commitments, make new investments, etc. At a smaller size in the fund. I think this, this sort of answers, why you should look at small caps now. I think the biggest factors which distinguishes small caps versus large caps is that small caps are simpler businesses. They are really, they're a lot of companies that we discussed in the first slide, they don't do exports. They are mostly dependent on the vibrancy of the domestic economy. If you see on absolute terms also, the small caps get almost 92% of their revenues from domestic sales only. And the 8% also, if we isolate some IT companies there, this number goes up even further. So clearly, I think small caps are more levered to domestic economic growth. And so we decided to see how the domestic economy is actually doing. And we referred to, if you see the slide on your left-hand side, lower slide, GDP growth for FY24 is about 7.6%. And if we just split it and see what has been the exports growth, export part of the GDP, how much is it growing? It's only 1.5%. So export growth is very anemic. Of course, it's because of the fact that interest rates have been very high, and some of the global markets have seen demand disruption. Some of the global markets have been affected very badly because of high inflation, high interest rates, and consequently, our exports have also been suffering. But what it also means is that the domestic GDP right now, without exports, is growing at about 9.5%, which is phenomenal growth. And if you see on this slide, this has happened earlier also. In FY15, exports were about 1.8% growth only, and overall GDP growth was 7.4%. Even at that time, 9.3% was kind of the domestic GDP growth, right? And this continued for a couple of years. The domestic GDP growth continued to be very strong. And you would remember that during this period, 15 to 17, 18, mid and small did quite well. And then subsequently, the cookie crumbled in 19 when the domestic GDP growth slipped behind the export growth. And that was pretty difficult for a period for small caps. So I'm not saying that, next 2-3 years, this similar pattern will exist, but I think it's a decent possibility because, because of the high interest rates, international markets will continue to be a little slow, whereas the domestic GDP right now is in a very strong momentum, and that strong momentum seems to continue over the next few years, and this will be good for small caps. I think one final thing I will say here that I think valuation is at the top of everybody's mind after such a very sharp growth in markets over last 1 year. And I just wanted to, there is a particular feeling that maybe small caps and mid caps are overvalued. But I think what this shows in front of you, that on an estimated PE basis, blended forward PE basis, small caps are probably as expensive or as cheap as the large caps. Mid caps are a little expensive. So point being that this PE is in a sense just a number, right? Because last year we would have said that PE is about 18 and 19, and from a historic perspective it is expensive. Yet the markets have gone up. So what exactly is happening here? So as per us, what's happening here is that the growth is pretty strong. And if you see the growth in EPS for the large cap index, it's about 14%. But for the mid cap index, it's about 25%. And in absolute terms, the small caps also are growing at about 19%, which is significantly higher than the large caps. So when we look at the PEG ratio, PEG ratio, price adjusted with earning growth, that is showing small caps to be actually cheaper by a margin than the large caps. So large caps are at about 1.56 PEG versus small caps at 1.19. Lower the PEG ratio, it is considered to be better. Yes, it would be a dream to get this PEG ratio below 1, etc. But those things and those events would come only when there is distress in the market. As things are right now, there is we are doing very well as an economy. The flows into equity markets are quite robust. Sentiment is quite strong. And this may continue for a while. So to that extent, I think waiting for a correction to get the index cheaper, it's a strategy which has really not worked over the last 2-3 years. And, I just wanted to say that, as a synopsis, that yes, markets all across are a little expensive. So we have to look at our asset allocation carefully and continue to participate in the market as our asset allocation allows us. The fear between different classes of market caps in the market may not be very rational because valuations are not too different on a growth adjusted basis. Just one more thing I wanted to say, that capability of the team here is very important when it comes to small cap stocks, because as per our study, out of the top 1,000 small cap stocks, 428 stocks are not covered by any analyst. So if we have to look at these companies, then the internal team of the AMC has to be competent enough to go do groundwork, put up a research report, and make the financial projections, etc. So there is no third party help. And I'm very happy to tell you that we have sort of built a very solid team, which is highly experienced in this kind of activity. I will not go through other sites which introduce the team, etc. What I will do is I'll just share one particular performance attribution for our schemes on a 1-year basis here. If you see, BSE 500 has given about 40% return. FlexiCap fund has given 60%, value has given 59.47. And just look at the breakup there. What you'll see is that about 18% of the returns of the FlexiCap fund has come from small caps. About 28.6, which is almost half of the return in the value fund has come from the small cap segment. So the point being that, we have built a team, we have built strong capabilities, and those capabilities in small, mid are being exhibited in our existing schemes. We did an NFO of a mid-cap fund also about 1.5 years back, and that's also performed decently behind that capability. So with that, I think I will just probably stop here. And, if there are any questions, probably we can just take that.
Yeah, thank you, Asit. Thank you for the wonderful presentation. It was really invaluable and insightful presentation that you have just given to us. So definitely, I'm sure many of our partners must have cleared their doubts also. So for the better understanding, let's start with the Q&A. So we
Thank you
have
very much, Disha.
received few of the questions. Thank you.
Yes.
We have received few of the questions from our partner. So I would like to display it on the
Sure.
screen. Give me a minute.
Sure.
Yeah. Is it visible on the screen?
No, Disha.
Yes.
If you can read it out, I'll be grateful.
Yeah. So I'll read out for you. What tenure one must look for
I can
to
see it
stay
now. Yeah.
invested in small cap fund? Yeah.
Sure.
Thank you.
See, this is really a financial planning related question, but I will answer it this way. Small caps historically have been considered to be a little volatile. They have exhibited volatility in different periods before, say if we go back 10 years, 15 years, they've exhibited significant volatility, even say 6, 7 years. So to that extent, I think a longer term exposure is an ideal way because there are a lot of opportunities. As our per capita income is changing, we will come up the aspiration curve. A lot of other businesses will start doing very well, and that opportunity worth playing. But a slightly longer term approach will help. I'm I don't think that previous and historic volatility, is the right way to look at it. But that's what the historic data suggests. See, the fact is that post categorization, there are a lot of small cap funds that are today existing, which probably were not there 10 years back, right? So there is a lot of institutional presence which is there in the small cap segment, which has increased the depth of the stocks, which has increased the volume in the counters. But that said, this will be decided only in the future. My simple answer to your question here is that please take a tenure of at least 3 years. And even better approach would be that post your investment in the NFO, do start an SIP because that will be the best way to play the longer term story.
Correct. Thank you so much, Asit, for the better understanding and giving the clarity to the question. So let's move to another question. Yeah.
Okay, I can see this question. Yeah, Disha, I can see this question. Yeah.
Okay.
So
I'll
the
just read
question
out for
is,
a better understanding.
yeah, sure, please go
For
ahead.
our partners. How will your fund differ from existing small caps that are currently performing well?
Differ. Okay, see, that's a very difficult question because see, I'll tell you, we have a specific investment strategy. Each fund house has a particular process and they invest as per the process. As you can see, our process has been growth oriented, where we try and pick up companies with superior balance sheets, higher ROE, lower debt, and also we have a very dynamic approach to managing volatility and the volatility as well as the beta of the portfolio, as well as the risks in the portfolio. See, we not only look at rewards, but we also look at how volatile could our portfolio be. I just wanted to highlight that all our funds, have a beta of less than 1. So that's been our endeavor. How to give returns without higher volatility, and I think that will be the cornerstone for us. So if you ask me what will differ us from other small cap funds, I would say two things. One, yes, we have built a team with good capabilities, but I'm sure there are a lot of smart people in the industry, and a lot of people are even smarter than us. They have very good track records, and my best wishes to everybody. Our approach would be similar to our other funds, where we focus on growth, but at the same time we approach the whole growth opportunity with some caution, with lower beta, and with higher quality approach.
Yeah.
Disha, I am sort of done with my question. Yeah.
Thank you. Let's move to another question. which is how important is the historical performance while investing in small caps?
Well, see, historical performance is an indicator, but you know how the mutual fund, disclaimers are. It's only past performance, right? It is an important indicator, but it's not the only indicator.
Yes, absolutely. Actually, this is the most common question that we receive, that whether should we consider the historical performance or we just should see the outlook of it.
No, I think, see, there is this, I understand the spirit behind this question because, it's easy to invest into something which has a track record. And like for our NFO, we really have no track record as of now. It's a new fund. But the way to see this is how, this last slide that I had shown, where we did exhibit our capabilities into investing in small caps in our existing funds as well, right? So we do have skill sets. We do have some outperformance coming through the small cap side. And to that extent, that also can be considered as a capability. I think, see, what you have to see is, does the fund house have a process which ensures some consistency and has capabilities to invest in small caps? If they do, then it should not be much of a worry.
True, true. Thank you for answering this question. Yeah. So this is a sort of interesting question. Can my portfolio consist of 100% small cap fund if want to invest for really long term, that is 25 years? So basically, always there is a perception in the industry that portfolio should be well diversified. But if somebody is looking for really long term, then is it advisable or not? Thank you. Over to you.
Yeah, that's a difficult question, Disha, because very frankly, if we go back, small caps have had periods of exuberance and then periods of, extremely poor returns. Okay. Now, the point is, yes, point to point, 25 years, because these companies are smaller and they capture these newer opportunities, your returns may be better. That is what our last 25 years is showing us, right? But my point is that I'll always follow up financial planners advice on this point, because there is no one size fits all. Also, 25 years we can invest, but at the end of the day, if something happens and you want to withdraw, say in 5 years, 6 years, 7 years, these are the things we need to consider. And hence, like we look at our portfolio, and I try to bring about a consistency in our portfolio rather than just a pure returns oriented approach. Investors should also balance their own portfolios. Yes, you can get superior returns, longer the time frame, volatility, beta, everything reduces and returns increases. That is there for everybody to see. But I would, advise for saner minds to prevail on this.
Sure, absolutely. Thank you. I'm sure my partner would have got the answer, because this was the question asked by a really aggressive investor.
Yes.
Yeah. Moving to the next. So looking at the global scenario, is it a right time to enter in the small cap fund, especially when the market is at high? So yes, this is the common question as well.
I know it's a very common question, but I'll tell you, when I joined this capital market, about 22 years back in my first job, the Sensex was at 3,000, Sensex and not Nifty, and today it's at 75,000. So point being that, I've seen so many highs that, today, if with this mindset, I would have to so probably jump off the building, right? But the fact is that nothing changes. Levels are different. Market is at an high, that's true. Valuations are higher, that's also true. But we have to consider the fact that our economy is doing much better than what we have seen in the recent time frame, even say last 2 decades. And our corporates today are also doing much better. The country is changing. There is a lot of innovation. There is a lot of hunger. We are seeing so many startups coming, so much vibrancy as far as the funding environment is concerned. So point is that, future looks quite good from here. India seems to be doing very well, from being insignificant about 20 years back in the global scene. Today, we seem to be, driving about 15% of global growth. That is where we are going right now. So I would look at the data. Yes, markets can correct any day. There can be subsequent events, but if we have a reasonable time frame, then this worry of market being high is really not required.
Yeah, fair point. Thank you. So moving to the last question. Yeah. So what is expected upside in small cap index from current market and time horizon for the investors to stay invested?
Yeah, I mean, I answered part of this question earlier, but
yes, absolutely.
Longer it is, it's better. Historically, we've seen that if you invest for it 7 years, the beta goes down and the returns go up. That's part of this presentation. This presentation also on our website, if you want to look at that data separately. Upside, I think longer term, what is the equity investors' upside, right? It is going to be a GDP growth. Basically, our broader indices will track the GDP growth plus inflation. So if we consider that our GDP growth is about 7.5%, 8%, plus an inflation of about, say, 4%. So 12% to 15% is a range that an investor should look for over a longer period. Now, when this is for the broader index. When you see, the point is, when you look at mid caps, you will expect a couple of percentage points more CAGR, and when you look at small caps, maybe another couple of percentage points more. So that's the expectation. It may not work out linearly, but if you see longer term, and if people who invested for 5 years, 7 years, 10 years, 15 years, they've always got this kind of an equation in returns. So I would think that this would be the broad math. And when we also look at, for our process, when we also look at companies, we try and get which have a top line growth between 12, 15, maybe 20%, also in some cases 25% in some cases, and we have a balanced portfolio.
Yes. So I think that was my last question from the investors' point of view. So we are done with the Q&A. So again, I would like to extend my heartfelt thanks for your presence and such a wonderful presentation.
Disha, I have one question, if you allow me.
Yeah. Sure, sir.
Yeah, I said this is actually not regarding the small cap fund, but I'm sure the question which I'm going to ask has a correlation with the small cap fund. See, JM Asset Management is making all right noises, and all your funds are ticking all green boxes, the flexi, value, mid cap, focused. So now you're featuring on top charts. What is happening, like how you're managing it? Well, markets are definitely supportive, but you are featuring on top charts. And I'm sure this fund will also make its presence felt, being in the quartile one, at least, so to say. And I'm sure it will be among rank 1, 2, 3. But what you're doing differently, that actually is keeping your schemes on top. And this can be a prospective pitch for our partners to carry to their clients.
Yeah. See, Anjani, actually, we have a process, and your question sort of tells me that there are very high expectations today versus, say, 2 years back when there were no expectations from JM Mutual Fund. So yeah, it's scary for us, and as a team, we'll try and do our best to meet expectations of people. But I'll tell you very frankly, we've never aimed for the first rank or the first quartile. Okay, what's there in our process is that how do we buy superior growth companies with lower volatility, and make lesser mistakes, and whatever mistakes we make, we cut them out quickly. That is what our broad philosophy is. And if you see, the whole objective was that we should be in Q2. And to be frank, that's how I'm measured internally, that a Q2 kind of a performance, but consistent for a longer time. But what we realized is, if you're consistently Q2 and you make lesser mistakes over 1 year, 2 year, 3 year, 1 month, 6 months, 10 months, you automatically you start going up the curve in ranking, and that's exactly what has happened to us. And Anjani, I just wanted to point out that this actually shows that the process is working, because see, we have very diverse funds which are doing well. We have a large cap fund with about 85% plus large caps, and as per the mandate minimum has to be 80%. That fund is also doing quite well. We have a mid-cap fund where SEBI requires us to have minimum 65% in mid-caps. That's also doing well. We have a Flexi, which over last 3 years at some time had 90% large caps, at some time had 35, 36% large cap. That's also doing well. We have a value fund, which is the lowest PE among all our funds and which is more small cap driven. That's also doing quite well. We have an aggressive hybrid fund, which has, at points of time, 30%, 35% debt to, 20% debt at aggressive times. That fund is also doing well. A focus fund, which was, the earlier core 11, where, we had a lot of negative perception from investors. That fund we restructured about 3 years back. We made it a focused fund, converted it. So we went from some 11 stocks to 30 stocks. And if you see, that fund has also turned around. So my point is that different funds, different sizes, different mandates, they've all done well. So I would credit my whole team, including my boss and my analysts, my co-professionals who have all been part of this great journey. I will also thank you guys, in the JM family who have consistently supported us with the flows. I'll, even, credit, the distributors who have continued to sell us. And if you see in this whole journey, we've really not advertised, we're not tom-tommed, it's just word of mouth which has taken us through. And what is more satisfying to us is that, the Flexi Cap fund, which we first started to push, which used to be less than 200 crores about 2 years back, today is more than 2,200 crores, or maybe a little more, and probably is getting more than its initial AUM every month now. So point is, we have been able to manage scale also quite well. One of the NFOs that we did earlier, the mid-cap fund, where we got less than 100 crores in the NFO, has crossed 1,000 crores today. And the performance continues to be consistent. So I think this is very satisfying to us that money has come, people have recognized, and we have continued the path. I would give full credit to the process that we have set, to the people that we have. And I would also say this, Anjane, one thing, that your expectations are very high. Please have moderate expectations for us. It's the best way to be positively surprised than to have very high expectations and be negatively surprised. We'll try to do our best. That's a part, but you know how markets are.
Absolutely. So it is like, promise less and deliver more. That's what is going to be the outcome. That with that belief, I go ahead on this. While you are being conservative in this part, but the point that you made is very, very strong, I must say. Process is something which is really something which we all should be looking at across the spectrum of all the products that you have, be it a focused fund to a flexi cap fund, and in between everything else. So everything is performing. That means it's the process which is right, and it is being followed on the right approach. And small cap getting added is, I'm sure, it's going to have the rub-off effect, as I said while I asked the question. So this will be a very good addition to the client's portfolio. That's what we feel. And the investors who come for it will definitely benefit from it. I really enjoyed your talk and the presentation of all the points. I'll hand it over to Disha to conclude it. Really, thank you so much.
Thank you very much, Anjana.
Thank you, sir.
Thanks for kind words.
Thank you. So yes, Asit, once again, I would like to give you a heartfelt thanks on behalf of my colleagues and my partners. Thank you for this lovely interaction with you. And I'm sure all my partners are having their insights and takeaways for this from this presentation. So definitely, we all will push this NFO to the full extent and will definitely deliver the best of the support to you and your team. Thank you once again, Asit.
Thank you, Disha, for being a wonderful host. Have all the best to everybody on this call. Let's all do well here. Thank you very much. Have a wonderful evening ahead.
Thank you. Thank you all our partners for sparing time for this event and making this a successful event. Thank you so much all.
Thanks. Bye.
With this, we are concluding the event. Thank you.
Yes.
Thank you.